This Excel workbook is going to help you understand the relationship between leverage in the capital structure of a firm, earnings, and the value of the firm. In Chapter 13, we learned that the capital structure of the firm can vary in terms of the proportion of leverage that's used on the balance sheet to support the firm's assets. And again, when we use the term leverage, we're talking about the amount of debt that the firm uses to support its assets versus equity. This worksheet is going to help us understand the interplay between leverage in the capital structure, the earnings of the firm. In this case in particular, we're going to look at EBIT, earnings before interest and taxes, and the value of the firm as measured by earnings per share or return on equity. This workbook has several worksheets. There's the data input worksheet. This is where you're going to put all the numbers to explore various scenarios. You will also use this Excel workbook to complete test 4. And to illustrate how to use this Excel workbook in solving these capital structure problems, I'm going to walk through a scenario where we look at the earnings per share if there's a normal economy. Because we're going to look at the earnings per share if there's a normal economy. And we're going to look at a situation where we're not taking into account taxes. So we're going to compare what are earnings per share for the firm if we have total assets of $100 million and we have EBIT of $7.5 million. Now, again, here are 3 scenarios for the same firm. Same firm, $100 million in assets, $100 million in assets. The only difference between these 3 scenarios, the no debt scenario, scenario A, where we have debt to equity of 1-to-1, and scenario B, where we have debt to equity of 3-to-1, is we've just changed the capital structure of the firm's balance sheet. In particular, here, if we had $100 million of assets and we borrowed $50 million under scenario A, so in this current scenario, we have no debt. In scenario A, what we've done is we've recapitalized the balance sheet, meaning we took $50 million worth of debt, we borrowed that, the firm borrowed that, and the firm repurchased half of the shares of equity that were outstanding. When there was no debt, the firm had 1.6 million shares of common stock outstanding. In scenario A, where we recapitalized the firm borrowed $50 million, and they took that $50 million and went out and bought 800,000 shares at $62.50. So they used up all the proceeds from the loan. So that leaves the firm with a recapitalized capital structure of $50 million in equity and $50 million in debt. Now in this scenario B, the firm borrowed $75 million, and they took that $75 million and repurchased 1.2 million shares at $62.50, thus dropping the total outstanding shares from 1.6 down to 400,000. Repurchasing those 1.2 million shares at $62.50 apiece used up the $75 million worth of debt that was borrowed. So again, these scenarios are where we have recapitalized. Now I'm going to go to this second worksheet, return on equity and earnings per share, no taxes, and see how earnings per share differs in the no debt scenario versus the scenario where we have debt to equity of 3-to-1, assuming we have an EBIT of $7.5 million. So I'm going to click on this worksheet, return on equity, earnings per share. If we have no debt, our EBIT under the normal scenario, normal economy, is $7.5 million. We have no interest expense because we didn't borrow any money. We have net income of $7.5 million because we also have no taxes. So our return on equity is going to be 7.5%. In other words, it's going to be the $7.5 million divided by the total number of shares outstanding. And you will recall total number of shares outstanding are 1.6 million. So if you take 7.5 million divided by 1.6 million, you will get and convert that to a percentage, you'll get a return on equity of 7.5%. Earnings per share with a capital structure of no debt of $4.69. Now let's compare this to the debt to equity ratio of 1-to-1. We have EBIT of $7.5 million. We have interest expense of $4 million because we have $50 million worth of debt at an interest rate of 8%. So that's $4 million. That leaves us net income of $3.5 million. And we divide that by the 800,000 shares outstanding. And that leaves us with a return on equity of 7%. And that leaves us with the earnings per share of $4.38. So if we have a normal economy and the firm earns an EBIT of $7.5 million, the firm would be better off with no leverage versus a debt to equity ratio of 1-to-1. If we compare the no debt scenario to the debt to equity ratio scenario of 1-to-1, we see that the firm is better off if you have an EBIT of $7.5 million with no debt, because you have return on equity of 7.5% in the no debt scenario versus you have a return on equity of 7% in the scenario where you have a debt ratio of 1-to-1. Similarly, we see that, again, the firm is better off if we compare earnings per share. If you have EBIT of $7.5 million, then the earnings per share in the no debt scenario is $4.69. In the scenario where you have a debt ratio of 1-to-1, the earnings per share is only $4.38, so it's less than the $4.69. If we have a boom economy where EBIT is $10.75 million, then the leverage helps us. So again, if we have a boom economy where the EBIT is $10.75 million, then the leverage helps us, because if we have EBIT of $10.75 million, we have no debt, we have return on equity of only 10.75%. But if we have a debt ratio of 1-to-1, then our return on equity is 13.5%, which is better than this 10.75. So if our EBIT is greater because there's a boom economy, then the leverage helps us. If we have a boom economy with an EBIT of $10.75 million, earnings per share in the no debt scenario is $6.72. Whereas if we have a leverage, we've got a debt ratio of 1-to-1, in that scenario, our earnings per share is $8.44, which is better than the $6.72. If we have a boom economy with an EBIT of $10.75 million, then the leverage helps us. Now, last but not least, let's look and see if there's a recession. If there's a recession and EBIT is only 4.5 million, if we have no debt, our return on equity is 4.5%. But let's see what happens if we have some leverage. If we have leverage of 1-to-1, then the leverage really hurts us if our EBIT is lower. So in this case, where the EBIT is only 4.5 million, our return on equity is 1%, which is much lower than the return on equity if we have no debt in the capital structure. So what we can conclude from this is that if EBIT is really low, if we have a bad economy, leverage really hurts you. And if EBIT is really high, we have a good economy, leverage really helps you. The data input worksheet is where you should be changing values to answer the various questions on the test. Now, as normal, if a cell is not colored yellow, if a cell is yellow, don't change it. If a cell is colored yellow, don't change it. If a cell is colored yellow, do not change it. Any of these other cells that are colored white, you can change, and you can even change these cells here for EBIT. You can change the values in these cells for EBIT. So if there's a recession, in this case we're saying that EBIT is going to be 4.5 million. If there is a normal economy, we're saying EBIT is going to be 7.5 million. And in this case, we're saying if there's a boom or expansion economy, saying EBIT is going to be 10.75 million. Now again, when you're taking the test, you can change these values. You can change any of the values in the white cells. Just do not change any of the values in the yellow cells. I have a little flag on the yellow cells that says do not change formula in the cell. So again, that's the input cell.